Good morning, good morning. It is, in fact, a great one. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. What an incredible Friday it is. Today is the 11th of November. I am JD Durkin. Opening bell rung just moments ago, of course, appropriately so, by the United States Armed Forces in celebration of Veterans Day. I need to say there have been members of the greatest generation, World War II veterans, here on the trading floor of the NYSE yesterday as well as today. What a privilege it is to connect with gentlemen from the greatest generation and all men and women in armed forces who are here. You will hear them, you will see them. We are endlessly thankful for all of their sacrifices and contributions to this nation. Also here, Building Homes for Heroes, a nonprofit that has now built and remodeled over 300 homes, which means when you're a TV host on the floor, you get the cool hat. Over 300 homes specifically for wounded veterans and their families. We're also thankful for their contributions to the veterans community. Stocks mounting their biggest one-day rally since 2020. Yesterday's session, a monster day here on the street. The S&P closing up 5.5%. The Dow finishing up 3.7%. The NASDAQ up more than 7% in the day. My goodness, lots of green on the board. This after the softer than expected inflation data from the October CPI, giving investors a bit of hope, perhaps, that inflation may, dare I say, have finally peaked, and the Fed's aggressive interest rate hike may be working. Let's take a closer look now what's on tap for this morning's broadcast. As you can already tell, there's a lot to talk about. We will kick things off by recapping yesterday's major rally on the street, which saw stocks surge on hopes that inflation is cooling. Plus, we dig into some good news out of China as the region announces it will relax some of its COVID-related restrictions. We haven't been able to say good news with that story in a while, but we do today. And finally, we'll bring you the latest updates in the FTX fiasco. Is it ever, as the embattled exchange files for Chapter 11 bankruptcy? Also fiasco at Twitter. I'm sure we'll get into it at some point as well. For more on those stories and so much more, let's now bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Martin, you've been up early today. I do want to get your perspective with the huge day on the street yesterday. Index is seeing their biggest one-day rally since 2020. What drove all of the optimism?
I mean, almost immediately, JD, it was the reaction to that inflation print, wasn't it? Essentially, what we saw was that deceleration in the headline to 7.7%. That was for the month of October compared to 8.2% in the month of September. It may not feel like much, and 7.7% is still a searing pace of consumer price increases for most Americans to bear. But it was indeed the slowest pace of gains since January of 2022. So we are moving in the right direction, and the derivative speed in which we are going there was much quicker than anybody anticipated. And I think even further underneath that, JD, was the fact that many of the subcomponents were also declining. What we've seen in previous prints over the past few months is that whilst we might see some deceleration at the headline or even core level, there was noise inside the subcomponents. When you're talking about things like rent, used cars, clothing, shoes and apparel, healthcare costs, all those sorts of things were kind of riding up and down without any particular sort of trajectory that economists could cling to. What we saw from the October numbers, though, was relatively consistent and moving in the singular direction. And that's, of course, slowing. And that was really what investors had hoped to find. And as a result, you saw the immediate pairing of bets on a 75 basis point rate hike from the Fed next month. They're actually looking now to 50, and that's almost a lock. And the expectation that the terminal Fed funds rate, rather than peaking at maybe 5.25%, might actually come in at 5% or possibly even lower if these numbers can be replicated. Various Fed speakers were out in the field yesterday saying, trying to tame some of the enthusiasm, given the fact that we saw that 1,200-point rally for the Dow, and I can understand why they would do so. But the bulk of the materials that I've been reading yesterday and again today all seem to suggest that peak inflation has arrived and that we are moving in a downward slope into next year, and that's going to change Fed thinking as a result.
Martin, Treasury yields also plunged. Give us a bit of a perspective as to why and what does it mean?
Well, Treasury yields are really the best indicator that we can all look at with respect to inflation dynamics, because as it's often been said, inflation is the enemy of bonds. If you have any investment that's going to pay you a series of payments in the future, they're going to be eroded by inflationary pressures. So therefore, their present price is going to be most sensitive to inflation dynamics. When bond traders see inflation easing, they will bid up the price of bonds because they would rather own them, particularly in a defensive environment where they think the economy is shrinking. And then we'll see Treasury yields decline. There was an auction earlier this week, JD, that didn't get a lot of press, but I thought it was interesting. The government sold about $35 billion worth of 10-year notes. The yield at the time was about 4.11. They immediately spiked up to about 4.15 right after the auction. This morning, 10-year notes are trading at 3.81%. That is a giant decline and really does suggest two things. First, bond investors aren't nearly as frightened of inflation dynamics as they have been for the past weeks and months. And secondarily, they're probably not that optimistic on overall growth. And those are two really important and twin components that drive fixed income prices. And we've seen both of them materialize this week.
Of course, one of the top stories, if we have a day where the NASDAQ pops more than 7%, tech is, of course, going to lead the way with huge numbers. Shares of Amazon yesterday up more than 12%. Yeah. Apple, Microsoft each advancing more than 8%. Shares of Meta rallying more than 10%. On top of the news yesterday, also cost-cutting measures announced earlier in the week there. Tesla more than 7%. Why do we see such major gains specifically in the tech sector, you think?
Almost precisely for the same reasons that we see them in bonds, JD. Apple, to some degree, acts like a bond. It has tremendous cash flows that it generates each and every quarter, much the same way that a treasury bond delivers cash flows to investors. So does Apple stock. So therefore, Apple becomes very sensitive to interest rate movements. And when we have that big decline in treasury bond yields, you're going to see a corresponding rise in the price of Apple stock. In fact, Apple stock yesterday, JD, recorded the biggest single day gain in terms of market value in U.S. history. Just over $190 billion was added to the market value of Apple in yesterday's trading session alone. And that really is indicative of how sensitive it can be to interest rate moves because of the cash flow component. Apple, many people say, is the biggest corporate bond in the world.
Monster day with the markets. Any reason to think that the bull market specifically is coming to a close? You get some sense there. I just want to help bring a little bit more information to our investors who might be wondering, what does the near-term forecast look like? Is the worst behind us?
I wouldn't say the worst is behind us, JD. There are so many moving parts this week. I would certainly say that peak inflation arguments are going to provide at least a floor to the market right now. But once that's neutralized, investors are going to be looking at the earnings component and the broader economic growth prospects. And both of those are not looking particularly solid. We'll probably see possibly even a decline, but probably flat earnings growth in the fourth quarter. And of course, there is increasing concern that the economy may slip into recession into the early months of next year. Neither of those are indicative of stock market performance. I think what we've seen over the past few weeks might be what many people describe as a bear market rally. In other words, in a downward trajectory market, you will sometimes get days and weeks of gains as investors maybe snap up some value stocks that they feel are cheap on a relative basis. But that doesn't necessarily mean that they have confidence in the market writ large. Another concern to keep in mind, JD, is the fact that we are heading into the end of the year. Investment managers that are sitting on even meager gains are going to protect those into the close of the calendar year in order to make sure that they protect their bonuses and their performance sort of metrics. And secondly, anybody who's sitting on the potential for a tax loss may indeed try to crystallize that between now and the end of the year in order to bring the benefit into the next tax year. Those are, again, two components that could add downward pressure to stocks going in to the second half of this month and indeed beyond.
Martin, it seems like every morning this week we have started off this broadcast and I've had you bring our viewers the latest bad news out of China. Maybe it's a little bit of a different story for this Friday. Stocks reacting to a bit of welcome news out of that country where they announced plans to actually soften some COVID restrictions. This might be the first time some people are hearing about it. What did they announce and why is it such a big deal for investors here?
Well, it wasn't an enormous announcement as such, JD, but you're absolutely right. It had a pretty significant impact on stocks. We saw a 7 or 8% gain for the Hang Seng in Hong Kong, and we saw solid gains for China stocks as well. Essentially, what the government said was that they were going to narrow the days in which someone might be confined with respect to a COVID infection. In other words, the quarantine period will go from 7 to 5 days, but it will still be in place. They're also going to scrap some of the fines that have been imposed on airlines for allegedly bringing in infected passengers. That will free up travel and will certainly be good news for tourism, the gaming industry in particular, and other areas of transport in and around the world's second largest economy. This isn't a sea change in terms of the government's zero COVID policies, which again are probably misguided, and they have certainly had an impact on broader growth. But we are seeing just slivers of change under the third term of Xi Jinping, and that's probably good news. I think it was more pronounced, JD, because it was overlaid with yesterday's rally on Wall Street and, of course, the corresponding decline in the US dollar. So you had firming of Asia currencies, a sliver of hope with respect to COVID policies, and that put together the rally that stocks have been looking for in that region, because it has to be remembered, they're trading at the lowest levels in more than 2 years.
I want to make sure I understand you there. It seems as if the updated guidance, if you will, is for individuals who have become infected. It doesn't sound like there's anything bigger with regards to, companies that do business there and the restrictions that they've faced in terms of shutting down production or having to stall components of their own day-to-day work. It sounds like this is for individuals who become infected. Did I understand you correctly?
Yes, no, you're absolutely right, JD. Essentially, companies that are in an area that is deemed to be at risk with respect to spreading COVID infections will probably have to either operate in what they call a closed loop, where employees stay on the premises for 24 to 48 or even longer hours until they can provide a negative COVID test, or indeed shut down altogether. So there will be supply chain implications continuing. But again, this is at least one step in the right direction, even though it isn't the massive change I think that many investors were looking for.
Is there any sense that China at some point looks to ease its zero COVID policy? I mean, have they said, okay, well, we'll do a good faith reading of where things are later into 2023, or as far as we know, this is how things are and how things will continue to be?
I think that's probably it, JD. The government isn't really the kind of leadership that would like to provide transparency on future decisions. This came essentially out of the blue overnight. In fact, about 24 hours after leaked messages suggested that they were going to maintain strict COVID policies into the beginning of next year. The Lunar Year holidays are coming up soon, of course. I very much doubt that the government is going to want to free up movement prior to that, because, of course, once those holidays are upon us in early February, you will see citizens around the country heading home, going off to travel, going off to stay with family for a full week period. And that is going to intensify any concerns about the spread of infections, particularly with these new variants. So I would be terribly surprised if there were big changes in restrictions until after that. The government may want to sort of monitor how things are developing, because they know they're going to get that natural increase in the early part of next year, tagged on to the lunar holiday travel.
Martin, of course, we've been talking about the election all week, which I know at this point the election feels as if it was at least a month ago. But if my math is correct, it was actually, I'm told from my producers, it was only 3 days, but none of us have slept since then, so it feels much longer. That can't be true. I know it's not really election day in America. It's election week. This is turning into election month. This is going to be election season. It's going to be some time here before we really get a sense. Did we learn anything new between yesterday and today for any of our viewers who maybe don't follow the minutia of politics and electoral vote counting? And by the way, if you don't, I'm very jealous.
Ah, indeed. It would be nice to live in that kind of bliss, wouldn't it? But we are inching closer to what the prediction.
Martin, I'm going to pause you for a second. I think we just lost Martin's audio for again. I'm going to look to recheck in. Martin, you got me okay?
I can hear you. How are you guys?
I got you. We got you right back on track. I think we just lost one sentence there, so go ahead. Thank you.
That's all right. I really think, JD, that we're inching closer to what was predicted on Tuesday evening, and that's a narrow majority in the House that will be held by Republicans. I think at last count, they have about 211 seats. 218, of course, are needed for control, and they'll probably have a majority somewhere between 5 and 7. That will be enough to check some of the executive orders that might be anticipated from President Joe Biden, but it won't be enough to really change significantly the anticipation of policy going into the final months of his term. The final 2 years, I should say. What's more likely to be in focus is what happens to the Senate. There are two races now which remain to be called in Arizona and in Nevada. And ultimately, if those are split, and that appears to be what the projections indicate, it will all come down to the runoff in Georgia on December the 6th. And that will be a spectacle to behold, because the weight of money, power, and influence that will be put towards that election, which will very likely determine the balance of the Senate, will be absolutely incredible to watch. So you're absolutely right in saying it's election season, because we may not know the result of that until well after the Fed meeting in early December, and indeed closer to Christmas time, by the time the votes are counted and the inevitable legal challenges are sorted through.
Yes, the inevitable legal challenges. Martin, I'm really happy you mentioned that, because people always forget that that is a huge part, unfortunately, of how the dust settles after elections. I'm also reminded of the late, great Tim Russert, who I used to watch when I was a kid. He used to stand there famously around election season and say, Florida, Florida, Florida. And now it appears as if it's less Florida, 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 and a bit more Georgia, 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 because now for another election, control of the high chamber could come down to what happens there in the Peach State. And we're going to be talking about that race for quite some time. But seeing as how we still don't know about control of Congress yet, and seeing the investor reaction yesterday, is it fair to say that inflation still remains the top concern for investors, given that reaction to the soft CPI data? Because they still don't really know what's going to happen with Congress, yet they had a very strong reaction to the inflation figures.
I think you've hit the nail on the head, JD. Ultimately, this is the Fed's market. And I think that's why the reaction yesterday was so visceral, because if we do have the assumption of a softer stance on inflation from the Federal Reserve, at least that's a policy track that people can understand. And I think what happened on Tuesday was you had neutralized the concern that there was going to be either significant Republican control or a holding of control from the Democrats. And I say that apolitically, because I don't really have a horse in the race. But I think what markets wanted to do was ensure that whoever did control, or if there was split control, it wasn't going to be a situation where new policies were going to come to the fore that would blunt growth prospects for American companies or indeed the broader economy. Now, that doesn't mean that a split Congress won't give you that, because there's still debt ceiling issues and spending issues and all the rest of it that have to be sorted through. But ultimately, the worst excesses of all of the parties were probably neutralized by Tuesday vote. And that ultimately means that markets are back to their focus on inflation, the Fed, earnings, and global geopolitics. And all of those, of course, are still raising significant questions. But one of them, at the very least, was, if not answered, it was certainly providing deeper clues than had given in the past. And that, of course, was yesterday's inflation reading.
It may be Friday, but that doesn't mean it's not a day with new data to pour through. At 10 a.m., we're going to get the University of Michigan consumer sentiment data. What do you expect, and what does it mean for someone who's watching?
The two things that are generally important out of the Michigan sentiment data, JD, are the fact that it tends to be very correlated with recent moves in the stock market. Americans' sentiment with respect to broader economic activity and their own personal wealth does tend to be tied to what they see in the S&P 500 and how their 401ks are performing. So it will be interesting to pick through that, because, of course, we've had this bounce in stocks over the past few weeks. Secondarily, the assumption is that there is going to be a pullback in inflation expectations, which curiously have been trading underneath what the market anticipates. Usually it's the other way around. So I'll be interested to look at the component of inflation expectations longer term from this series of data, because that will tell us a lot about the anticipation for consumer spending heading into the second part of this month, and of course into Black Friday and beyond, because that will be very important with respect to growth prospects here in the US and indeed broader market performance into next year.
Absolutely. I don't want to interrupt here. I just want to make a quick note here that as we are on the floor, we do have men and women in uniform. They are pausing, they are watching our feed, because we have it on right above our heads. And again, in case anyone happens to trickle through the shot, I want our viewers to know it's a very special day here on the floor. Great energy from all those men and women in uniform. I just wanted to briefly set the scene in case you hear a lot of commotion going on behind me, and it's great to have them here. I do want to get your perspective here on Twitter.
Oh, gosh.
I mean, my God, this is the story that just keeps giving to headline writers. Imagine being a breaking news writer and your sole task in the newsroom is to cover all of the drama with Elon Musk and Twitter. You also haven't slept all week, like those of us who follow elections. Musk telling Twitter staff that he sold more Tesla stock in order to save the social platform another $4 billion worth. That's now almost $19 billion in Tesla stock he has sold through 3 tranches this year. Is this a reason for some Tesla bulls to now start getting a little bit nervous about how their guy is going about having to fund Twitter?
Well, if they're not nervous now, they probably should have been, because there's been a lot of run up to this, JD. The stock is down a bit more than 50% since the Twitter acquisition was made public in early April. And as we talked about earlier this week, the stock hit, a 2-year low as a result of some of the mechanics of those sales, and of course the anticipation of maybe softer demand in China. It was an unusual statement that I saw from Musk on Twitter overnight, in which he said that his other companies are fine and that he expects them to perform well into 2023. That's the kind of non sequitur that you don't really want if you are a Tesla shareholder. You would prefer that company executives are on balance, positive about their company's prospects. They don't need to say it, because ultimately it's just baked into the assumption. So anytime somebody provides that detail unprompted, that's when you get worried. Now, of course, he's had tremendous success with a lot of the companies that he's run, so he's not someone that I would question that freely and without concern. But in this case, you are talking about someone who is now at the helm of about 4 or 5 companies of various size, many of which are facing significant challenges, all of them different. And he's now mired in a company that was worth $44 billion and is certainly now. In fact, some of the debt prices that we are seeing in the loans that underpinned his purchase suggest Twitter could be only worth about $10 to $12 billion. Now, that may not be accurate, but it's certainly numbers that are floating out there. So I think this does raise concern as to where he's headed with this company, and ultimately what impact it will have on Tesla as he's distracted by the challenge in making Twitter profitable.
I think distracted is the right use of the word for that case there. And you've also seen advertisers flee, right? General Mills, General Motors, Audi, Volkswagen, huge names have either paused or completely pulled out of their advertising contracts with the platform until Elon Musk and other people in senior leadership now can prove that the platform can do a good job curbing against hate speech and online harassment. And that's a big problem, isn't it? Because there are already huge advertising headwinds. We've seen from Snap, we've seen from Google, we've seen from Facebook. I feel like Elon Musk has now put himself in a situation where, in terms of ad spending, he's made it even more difficult on himself in what was already a very difficult digital ad spending environment.
No question about it. And that's why I think he was so focused on increasing subscription revenue, because he knew that he was going to have to offset the inevitable fall off in advertising spend, even if there wasn't hate speech on the platform, because we've had Google, we've had Meta, we've had Snap, and everybody else tell us that they are seeing significant declines in ad spend as the economy deteriorates both here and abroad. He's compounded that problem, of course, by saying that he wants this to be some kind of free speech platform in which people are allowed to share views of all kinds. That's probably not a bad thing, as long as you can temper the worst excesses of some of the bots and others on the platform who have basically made it worse for everyone else. Even more so, JD, what happened last night was even more farcical, in the sense that these Twitter badges, which many people assumed were part of a verification process, found us looking at companies that we thought were real, making ridiculous statements that turned out to be simply fake. In other words, you had Eli Lilly, or somebody pretending to be Eli Lilly, with a blue badge, making statements about offering free insulin. Now, of course, it turned out that somebody just created this account, purchased a blue badge, but acted as if it had been verified. So there were several other companies that were caught up in that maelstrom as well. So now what you have is a backtracking of that process, and possibly a return to the old method of verification. But again, we do wonder whether celebrities, companies, and others will want to pay for verification and then provide free content to the world's richest man. My suspicion is they probably won't.
You're a Twitter user like me. I feel like every newscast that I've watched on this issue, at some point they ask each other, oh, are you going to pay the $8 for the badge? Based on what you know, Martin, I have to ask you, I mean, we're still learning what the features are, but do you think you'll be paying $8 for whatever the subscription features end up being?
Yeah, probably not. I mean, I would absolutely pay to use Twitter because it is the go-to destination for me on the web. In some ways, it's replaced newspapers in a lot of ways, simply because I have been able to tailor the people I follow to such a degree that I get the news I want, not only in the finance world, but in sports, in politics, and indeed elsewhere. So unless the mechanics of that change, I wouldn't see the need for verification of my views, because they tend to be seen in the context of the group of people that I follow and those that follow me. Although I can understand why other people may wish to get some of the features and to pay for the verification because they want to amplify their views to a larger audience. At present, I'm content with what I have, and I'm certainly hopeful that it doesn't shrink.
Yeah, well, we certainly see. I wonder to what degree of the existing features they look to scale back to further incentivize people like you and me to pay that $8. You know, do they kind of cheapen the product that we're used to in order to kind of make that incentive? I don't know. It's who knows, right? I don't think he knows clearly, as we've seen. Okay, so from one fiasco to the other, we now pivot to FTX, that company filing for Chapter 11 bankruptcy early this morning. What do we know so far here, Martin? My goodness.
Yeah, just a brand new filing, really. It's going to be contested in Delaware. It's a voluntary Chapter 11 filing. For those who aren't familiar with that term, essentially, it's a form of the U.S. bankruptcy code that allows time for companies to pause activities and discussions and with their creditors in order to allow for a transformation of the business in which it will exit the other side, usually with a reduced debt load, but also as a result with a larger portion of the ownership handed over to the creditors. Essentially, what happens in that Chapter 11 process is that creditors are given particular rank, and they, of course, have the first bite at whatever assets are left over. Investors, stockholders, depositors are at the bottom rung of that hierarchy, and as a result, usually end up having to pay whatever assets they have to the creditors themselves. It's unclear at this point, JD, exactly what assets are remaining apart from deposits and maybe apart from some cryptocurrencies that haven't been sold over the past few days. And that's probably why we're seeing such a decline now in cryptocurrency prices, because people will assume that they'll be sold in order to satisfy creditors, because the last thing a creditor in this instance is going to want to do is take payment in cryptocurrencies if they see the value falling. So a lot to pick through and early doors with respect to what we know from the filing. But the other thing that we do know is that Sam Bankman-Fried has stepped down as CEO. That's no great surprise considering the fiasco that he's orchestrated over the past 7 days. But what's more troubling to me, JD, is that only yesterday, just 24 hours ago, he was on Twitter saying that U.S. assets were fine. He made that statement pretty significantly, quite clearly on his verified account. 24 hours after that, they're filing for bankruptcy protection. When regulators and federal officials and everybody else is circling this company, these are not the sorts of statements that you want to have out there in the public. And the contrast in that is going to be something, I think, that will generate a lot of interest, I want to say tamely, over the next weeks and months.
Yeah, and it was not a parody account that was verified for Sam Bankman-Fried. I want to clarify, because there's a lot of parody accounts now, and you can buy your $8.
That's a fair
this
point.
was the man himself who said one thing, and we all woke up to a dramatically different environment within a day later. Third quarter earnings season here, Martin, is also wrapping up. Give me some of your biggest takeaways. I feel like we had the highest of highs, the lowest of lows. A whole bunch of headlines here the last couple of weeks with regards to earnings for investors to digest. What stands out to you as we wrap up more or less the Q3 season?
I mean, I thought the season was okay. Ultimately, when you strip away energy, you're going to see an overall decline in third quarter earnings. But really, I think tech came in okay, not terrible, apart from the ad spend. I think you saw a little bit of resilience. I think Apple's numbers certainly rescued what could have been a terrible week last week with respect to its relatively optimistic fourth quarter outlook. But we'll see where that takes us. Next week, I think, will be fascinating, JD, because we're going to get a lot of big ticket names on the retail space, Target, Walmart, and Home Depot being the largest three, and a look at October retail sales as well. So we'll get a really good understanding of consumer strength as we wrap up the third quarter earnings season and where we are headed over the final months of the year.
Martin, I also want to throw a random topic with you to end this first block of the show, because it's been a while since you and I have talked specifically about the strength of the U.S. dollar. It's been a couple weeks since that was really a top headline-making item, and I was thinking about this yesterday, and I said I'd love to get Martin's update on the show, just for any of our viewers who probably have seen those headlines, or have heard you and I talk about it on previous broadcasts and have said, with all the election mess, with everything in Twitter and earnings, what happened to the greenback? Have we had major updates on that story in the last couple of weeks, I wonder?
Yeah, for sure. I mean, yesterday, JD, was the biggest single-day decline for the dollar since 2009. That's ordinarily the type of thing that would raise a lot of concern with investors around the world. But the dollar had been trading at 20-plus year highs against a basket of global peers for much of the past few months. So it was very necessary to take some steam out of that. And of course, the reason why was that we had these big changes in Fed interest rate assumptions and a big decline in U.S. Treasury bond yields. So we had the big sharp drawdown of U.S. dollar strength overnight. That is extending into today's session. And that generally means two things. Firstly, it means that investors are pricing in fewer and smaller rate hikes from the Fed. But secondarily, it's an indication of overall bullishness, because people tend to exit the US dollar and they go into other currencies when they're feeling a little bit more risk appetite. And that's certainly what we've seen for the past 2 or 3 sessions. And that's good news. Now, on the inflation front, it's not the best news, simply because a weaker dollar makes exports more expensive, and that can add to consumer price pressures. But that's an issue for much further down the line. The corresponding gains for foreign currencies, the euro, the pound, the yuan, the yen, etc., are probably more important for the global economic prospects, because they tamp down energy export prices and will lower inflation in those economies if the dollar weakness is maintained. So it tends to be a very important story. And whilst weaker dollar headlines might give some people concern, in this instance, it's welcome news, and that's why the markets are reacting as such.
All right, time now for our rapid fire section here to finish off the morning broadcast. Number one, if you're ready for this, my friend, today is the biggest shopping day. Wait, what? Today's the biggest shopping day on the planet. There we go. What is Singles Day? I legitimately don't know. What is Singles Day?
Yeah, Double 11 Day, as they call it in China. It's essentially a holiday that was manufactured to some degree to represent a bit of concern about loneliness in the world's largest economy. There's a great demographic imbalance, as we all know, as a result of one-child policies in the 70s and 80s. But nonetheless, this sort of manufactured event has developed over the past 14 or 15 years to be an incredible sort of shopping festival in which many of the big tech companies, the rivals to Amazon, such as Alibaba, JD.com, etc., put their best sales out there and generate tons of revenues and profits over the final months of the year. But of course, China's economy is in the doldrums as a result of these COVID restrictions. And this year's tally is going to be anything compared to what we've seen in the past. Nonetheless, the figures do suggest that Alibaba, which is the benchmark for all this, it's the Amazon of China, will probably generate somewhere between $75 and $77 billion worth of sales on today itself. That's about 2 or 3% higher than last year, but probably the slowest rate of growth that we've seen in a decade, again, representing the weakness that we're seeing in the China economy. But nonetheless, when you compare it to Black Friday, it still remains the biggest shopping day of the year.
All right, number 2 on our rapid fire list. This is something that Elon Musk at least floated to employees in the last 48 hours. Could Twitter actually go bankrupt next year, Martin?
Well, it would surprise me, JD, but he said he couldn't rule it out. He was speaking to employees for the first time in an all-hands call, and essentially he said, you know, this is a possibility if we don't get our act together. It's a technique that he's used in the past to sort of motivate staff. So I don't know how seriously, maybe I should say it this way, JD. Maybe we should take him seriously, but not literally. And where have we heard that before in reference to what political leader? I know the comparisons are a little bit worrying. But that kind of hyperbole is typical, and I would imagine that's what we're looking at here today.
I don't remotely blame you for saying it, but my God, the flashbacks I just had the second you had that. And for a bit of context, especially for those of us that were politics reporters, covering the ins and outs of the election of 2016 and the presidency of Donald Trump, that's what we famously said. You take the man seriously, or do you take him literally, the way maybe too many in the media did? And yeah, there's a lot of comparison. You and I should do a special show on the comparisons between Elon Musk and Donald Trump, because it would be like a multi-hour special in prime time. Let's have a little bit of fun here to wrap things up here. how is this? Wait, is this right on my prompter? Is it already week 10 of the NFL season? No, that can't be right.
Can you believe that?
10? Oh my goodness! What's
10.
on your radar here for week 10? Wow.
It's going to be fun to watch that game in Germany. I think it's Seattle versus Tampa Bay. And who would have thought that the MVP discussion with respect to quarterback wouldn't be Tom Brady, but actually Geno Smith? I didn't have that on my NFL bingo card when we started the year. But I'll be fascinated to see what crowds we get in Europe. I've always said that Europe can absolutely support an NFL team based on the number of games that I've seen. Both on the continent and in London, the sport is incredibly popular and could absolutely fill a stadium for 8 games if that were indeed the case. And maybe as well, JD, we might see a new receiving record, at least on the way this Sunday if Tyreek Hill has another game for the Dolphins, as he's been doing for most of the season. He and, of course, Tua Tagovailoa have just created this incredible partnership of athleticism and instinct. And as a result, he's having a season for the ages. So I'll watch that as well.
Yeah, of course. You got Dolphins, Browns. I've got the Houston Texans visiting my beloved New York Football Giants. I will be over there. And by the way, to this point about success in Europe, you know that I was just in Portugal. I went to my first Portuguese Liga soccer match, which soccer matches there put all American sports to shame. I will never look at American sports the same after seeing how amazing the fan base was there in Lisbon for Sporting Portugal. But to this other point, yeah, American football is actually much more popular in casual conversations with people around Portugal. Yeah. People were really into it. They knew Tom Brady. They knew about the retirement storyline. They had some teams they would kind of loosely follow. So you might be onto something there. Certainly the NFL has put a lot of money and resources the last decade into expanding the game overseas. And we will see what week 10, can't believe it's already week 10, has in store. Martin Baccardax, a fantastic week, a great conversation. One more time here for all of our men and women here here we go, in uniform. Happy Veterans Day, everyone. Thank you for your service. Thanks for being here on the floor.
Indeed.
Great to have all of you. There we go, folks. That's what it's all about. Nothing more important. Martin, a great week of conversation. Thanks for doing the show, man.
Thanks, JD.
Absolutely, folks. That's going to do it for the Market Open here from the floor of the NYC. Again, a very, very sincere and happy Veterans Day to all who have served this great country. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. We'll see you next week.